Hey everyone, I've probably heard of the Bank of Canada's latest supersized 50 basis points interest rate cut last week. Put it in perspective, the last time the Bank of Canada has cut interest rate by 50 basis points was during the peak of the pandemic in March 2020. Prior to that was during the 2008 financial crisis, so it is pretty significant for Bank of Canada to take such a large move. Today we're going to break down what it means for inflation, jobs, and the housing market. Also talk about where rates are headed next with insights from major Canadian banks. So let's dive into the details. First, why is the Bank of Canada cutting rates so aggressively? Well, after battling inflation for nearly 2 years, we're finally seeing some light at the end of the tunnel. In September, inflation dropped to 1.6%, which is right within the bank's target range of 1 to 3%. So what's the next challenge? Sluggish economic growth. Cutting rates by 50 basis points, bringing the key rate down to 3.75%, is the bank's way of jumpstarting the economy. Goal is to boost consumer spending and investment to avoid a recession. Governor Tiff Macklem said it himself, we're back to low inflation. Now we need to keep it there and support growth. Let's talk numbers. Inflation is now back to a manageable 1.6%, down from a peak of 8.1% in June 2022. This is a huge relief for Canadians who've been grappling with skyrocketing costs for groceries, gas, and housing. But with inflation under control, the bank is now turning its attention to another problem: unemployment. Canada's unemployment rate currently sits at 5.5%, but cracks are starting to show, particularly among young people and newcomers. Businesses are cutting back on hiring, and wage growth has slowed. The bank's challenge now is to prevent this from spiraling into a bigger problem. In terms of the impact on the housing market, with the 50 basis point cut, the mortgage cost will reduce for variable rate mortgage holders. They will feel an immediate benefit as their monthly payments are likely to decrease. Banks have all lowered their prime rates by 50 basis points, from 6.45% to 5.95%. However, if you have a fixed rate mortgage, you won't feel the effects just yet, as fixed rates are tied to the bond market, not directly to the Bank of Canada's rate. Good news, if bond yields fall in response to these rate cuts, we could see fixed mortgage rates trending lower as well. So what's next for interest rates? I have outlined here a summary of what Canada's major banks are predicting for future rate cuts after this jumbo cut in October. As you can see, most major banks are forecasting a smaller 25 basis point cut in December, followed by more gradual reductions throughout 2025. Economists are cautiously optimistic, but they're also watching closely to ensure inflation doesn't bounce back. Overall, it's clear that we're in for more rate cuts, but at a slower pace, depending on inflation, job numbers, and global factors like the US interest rate decisions. Here's my take on this. It's easier for the Bank of Canada to control inflation than it is to reduce unemployment. They have a clear tool: interest rates. When inflation is high, they can increase rates, which slows down borrowing and spending. But when unemployment rises, lowering rates doesn't have an immediate or guaranteed effect. It's a more indirect process. Cheaper borrowing helps businesses and consumers, but it takes time to see real job growth. So, if the Bank of Canada has to choose a battle to fight, they should lean more towards fixing high unemployment and the economy than inflation. There you have it, a deep dive into the Bank of Canada's latest rate cut and what it means for you. Whether you're a homeowner, a job seeker, or just someone trying to stay on top of these financial changes, it's important to stay informed. If you found this video helpful, make sure to hit that like button, subscribe, and turn on notifications for more updates on personal finance and economic news. Thanks for watching, and I'll see you in the next video.